Hey there, financial friends. Welcome back to another exciting episode of the Investing Iguana. I'm your host, and today we're diving into the world of stocks on the Nasdaq Composite. We're here to discuss whether it's time to consider buying the 3 worst performing stocks from May. So, grab your favorite beverage and let's jump right in. Alright, folks, let's start with the big news. The Nasdaq Composite has been soaring this year, up a staggering 25% and reclaiming half of last year's losses. But hey, not every stock can be a winner, right? Even during the tech sector's rally in May, there were a few stocks that took a tumble. So, let's take a closer look at the 3 worst performers from the Nasdaq 100 index and see if there's any hidden potential. Coming in at number 1, we have PayPal, and boy, did they have a rough month. PayPal, the digital payments leader, faced challenges on multiple fronts. First, they found themselves losing market share to Apple, who wielded their installed base of over 1 billion devices to push their own payment platform, Apple Pay. Ouch! On top of that, the entire fintech sector took a hit from weakened consumer spending and the fading online spending frenzy that we saw during the pandemic. PayPal CEO, Dan Schulman, even announced he'll be stepping down at the end of the year. A bit of a shakeup, huh? To combat their challenges, PayPal had to make some tough decisions, including laying off 7% of their staff. But hey, here's the silver lining: their stock is now trading at just 13 times this year's expected adjusted earnings. It might be a great opportunity to snag this leading fintech stock at a bargain price. Moving on to number 2 on our list, we have Warner Bros. Discovery. This media stock faced a double whammy last month. First, their earnings report was nothing to write home about, leaving investors a bit disappointed. But wait, there's more. The ongoing writers' strike in Hollywood added to the company's challenges, impacting their ability to produce new content and attracting users to their networks and streaming services. Now, Warner Bros. Discovery did launch its new streaming service, combining HBO Max and Discovery Plus. Although, I must say, some critics questioned the wisdom of eliminating the HBO brand from the title. With the strike lingering, weakness in the ad market, intense competition in streaming, and a hefty $50 billion debt on their balance sheet, it's clear this stock might have some more hurdles to jump. Lastly, let's talk about everyone's favorite morning pick-me-up, Starbucks. While they posted solid earnings last month, the stock took a bit of a tumble. Why, you ask? Well, Starbucks decided not to raise their guidance for the full year, which left investors feeling a tad cautious about the company's future performance. On the bright side, Starbucks saw some positive growth in their fiscal second quarter numbers. Revenue was up 14% year over year, with comparable sales rising globally. They even had a nice boost from reopening stores in China and moving past the peak of the COVID-19 Omicron variant in the United States. But still, with investors fearing declining demand for discretionary goods, Starbucks stock faced a bit of a retail sector slump. However, some wise market watchers see this as a potential buying opportunity. Starbucks seems to be on stable footing following the disruptions caused by the pandemic. They're even targeting 15% to 20% EPS growth in 2023. That's not too shabby. And there you have it, my savvy investors. We've taken a closer look at the 3 worst performers on the Nasdaq Composite for May. PayPal, Warner Bros. Discovery, and Starbucks all faced their fair share of challenges, but hey, that doesn't mean they're out of the game just yet. As always, make sure to do your own research before making any investment decisions. Thanks for joining me today, and don't forget to like, subscribe, and hit that notification bell so you never miss an update from the Investing Iguana. Until next time, happy investing.